the same house prior to COVID in 2019 was about 260,000. Today, that same home is about 440,000 nationwide. And so that's an astronomical increase.
Hi, this is Mike Maloney, and I want to introduce everybody to a new friend of mine, Carl Kruger. Carl, how are you doing?
Doing really well, Mike. Thank you.
Good.
For joining in.
Yeah, you're a financial consultant, right? What's your title?
A senior wealth advisor with a firm in Houston. So we basically are personal financial advisors.
Okay. So you've got some information that you posted recently on your LinkedIn site. Can you show us that and go over it a little bit for us? And it has to do with real estate. And yeah, so.
Sure. Yes. So basically, one of the things that, as you well know, Mike, in the recent, with the recent rise in interest rates and some of the post-COVID, peculiarities with the money supply. Obviously, the money supply has increased dramatically after COVID, combined with significantly rising interest rates. What if interest rates have gone up something like almost 5+% in the span of just the past year and a half, not even quite a year.
They've gone up to 5+%. They have gone up by like 5,800%.
Exactly. Right. So that's I agree with you on that. Right. So in terms of affordability of housing in the United States, of course, that's had a dramatic impact as we were talking about. And so when you look at, this is actually a chart that kind of highlights that. And so when you look at the basically home affordability, we're now at one of the least affordable times ever in U.S. history, at least in modern history, going back to the late 70s, early 80s.
Yeah, when it peaked there, hang on one second. I'm traveling. I'm on the road. I'm in a hotel, and I just need to take a closer look at your chart because it's pretty small on my laptop. And so there's a percentage on the side. Oh, okay. As a percentage of income, 70%. Well, that's impossible to maintain, to sustain. And that was 1980. What's interesting is real estate wasn't at the end of a bull market. It maintained its bull market. It was incredibly resilient for a long, long time. And it was more toward the beginning of a bull market then. So now you've got these overpriced homes in this new interest rate environment. So this is a measure, if you take the same home year after year, what's it going to cost you to buy that home and finance that home with the interest rates? What percentage of the average income is it going to take?
Exactly.
Yeah. Exactly. It's pretty breathtaking, and it shows you that the real estate bubbles really should be popping at any moment.
Yeah, and so some of the dynamics, now it's debatable, but it may have changed. When you go back to the late 70s, early 80s, of course, during those extreme, periods where you had super high interest rates and very high inflation that the Fed was, attempting to correct for, that basically. Back then, housing eventually corrected in price, significantly, with those high interest rates. Today, it's debatable. We'll have to wait and see how this plays out.
Yeah.
But the post-COVID, money printing combined now with this incredible rise in interest rates is actually one of the fastest, if not the fastest single rise in interest rates ever in history, or 5% or more. So now you're coming up, basically you have this higher plateau of prices, perhaps in housing across the United States. There's certain pockets that have sold off, but now you have a higher plateau of prices combined with much higher interest rates, right? What, in the 7.5% range on a 30-year mortgage, coming from about a 3% mortgage, back in early, say, 2022. Yeah. And so much higher prices combined with much higher interest rates, just a double whammy effect in the U.S. housing market. And so much of this is, of course, due to COVID and the aftermath of COVID and the money printing, right, that we saw that was, extreme by any measurement that you can possibly come up with.
Currency printing.
My bad. Exactly.
I make the contention, and a lot of people think I'm crazy.
I 100% agree with you.
When I was writing my first book, that's when I realized, wow, part of the key functions of money, and Aristotle was the first to describe it, a medium of exchange, a unit of account, and a store of value. If it can't serve those functions, it is not money. And I decided to make the distinction between these with and it's the first episode of Hidden Secrets of Money.
Absolutely.
And I've been just standing fast on this principle. And a lot of people think that I'm crazy. And because
I think you're exactly right.
It's cumbersome to try and always use the right words. But Confucius said that using the correct language is the first step toward knowledge. Something like that.
Right. Sure.
And, truth and understanding depends on how well we can communicate and understand each other. And if we use the wrong words, and money is definitely the wrong word for national fiat currencies that must lose value over time based on their very design. If you don't keep expanding the currency supply forever, the interest owed on it eats it up. You go into this deflationary implosion, and you always have to expand the currency supply. And the way that works is with new loans. And for the first time since the Great Depression, M2 is contracting right now.
That's right.
Pretty scary. Yet the bubbles continue.
It's amazing. It's amazing. So absolutely, I'm 100% on board with you. It's currency, not money, that we're now dealing with, and so there is no store of value in what we use as a medium of exchange. And so, as that currency expands, right, in supply over time, of course, then prices, reflect that expansion of the currency. I think we're seeing that in spades in the housing market, and combined with the unaffordability, what the average per capita income is about $56,000. That the same house prior to COVID in 2019 was about $260,000. Today, that same home is about $440,000 nationwide, and so that's an astronomical increase. And combined with now a 7.5% 30-year mortgage, this is a brand new world that it's becoming just totally unaffordable for people.
Yeah, I see it as a recipe for disaster for the vast majority of the population. But when you measure things in value, not price, and you try and price them with something else. How many shares of Dow is a single-family median price home worth?
Sure.
How many barrels of oil, and how many ounces of gold is that?
That's right.
And when you look at it that way, you can see that a home has become very, very expensive lately. Gold hasn't really moved much, and oil hasn't moved that much, but real estate has moved, like you said, from before COVID to after COVID.
About a 70% increase on average, which is just nothing like that's ever taken place in U.S. history ever. And so you're exactly right. When measured in real things, that's a totally different measurement.
Yeah, and everything reverts to the mean, and when it reverts to the mean, it usually overshoots to the opposite extreme. So I'm going to take. So we are over the 50% mark right now.
Yeah, exactly.
That is an enormous percentage of the average person's income, where, So just in 2020, it was down at about what, 24 or 25% of the average person's income.
Basically one of the lowest points in the past, 45 plus years, right?
Yeah, right. So it was very affordable. Now it's shot to the opposite extreme. The rule of thumb used to be that about a third of your income is what you can afford if you're going to try to finance a home. And here we are at over half. It really, real estate needs to come down by a long ways. So this was great. I want to try and make a short video this time. So this was one topic, and we'll get together soon. I thank you very much for presenting this material. So everybody can look for Carl E. Kruger on LinkedIn, and you can read his comments here. So I want to thank you, Carl, for joining me and presenting this information.
Great. Thank you, Mike. This was excellent. Been a fan of yours for years, as you know, and so look forward to being a contributor and helping out the mission of Gold Silver any way I can.
Okay. We'll see you next time.
Great.
Thanks
So much.